Welcome, everybody. We're going to do a quick tariff talk. I know we've done videos on this in the past, but the headlines continue to be exciting. Every day there seems to be something new or another twist or turn on the ongoing tariff saga. So we did want to post an update. And as usual, before we get too far into any video, we always have to list the disclaimer. I'll make it big here so you can see. We will go through the recent drama when it comes to tariffs, the market impact, what we believe is on the horizon, to give you an update on our thoughts and views with what is going on. I think that's a good place to start as well, Kevin, is the ongoing tariff saga. Lots of twists and turns. What is happening with tariffs?
Yeah, with the new U.S. administration, we had found out sort of early in that presidency that, there was going to be some tariffs coming around. First, they were going to be going after Canada and Mexico based on the fentanyl scenario, is what it's been posed as. That was going to take effect in February. What we found, it was postponed 30 days to take effect in March, and it did from there. And then what we saw was that after this went in originally, we are going to see the rest of the world getting tariffs starting on April 2nd. That did come to fruition. So what we saw was tariffs going on at a variety of different prices, at a variety of different percentages for different countries, and who was exempt, who wasn't exempt, and how it was going to play out. And since then, we've seen a variety of different things past the April 2nd timeframe as well.
Yeah, leading into April 2nd, I think the expectation was we'd see a 10% tariff. That was mentioned on the campaign trail, was mentioned earlier in the year, and then you got something completely different, far more aggressive measures, and the market had a big reaction. But then you had a U-turn. Effectively, the U.S. administration hit the pause button, said 90 days to negotiate all those big tariffs off the board, which was welcome relief for the markets, with the exception of China. They did escalate their negotiations with China, but even there we had some softening over the weekend, a long list of exemptions, everything from smartphones to flash drives to electronic components, flat screen TVs. It was a really big list that effectively said all those Chinese import tariffs don't apply to this big list. So softening there as well. And then even yesterday, the president did mention they may even look to help the auto sector. So we've seen a U-turn, very aggressive measures, some pausing, some softening. Market has reacted to that, and also a little bit of clarity, because you might remember on April 2nd when these aggressive measures came out, there's a whole host of theories in terms of what was trying to be accomplished, what was the end game. Now it seems pretty clear it's a negotiation tactic, and that is what they're trying to do. So a little bit of clarity, some softening there, which has been welcome relief for markets. However, it's not without some kind of economic impact.
Yeah, I mean, economic impact has been caused very vast. I mean, and the biggest factor has been because of uncertainty. I mean, if you're running a business right now, you're probably not spending money to upgrade your plants or maybe hire any more new people because you don't know whether or not what your cost structure is going to look like, because you don't know what the impending tariffs may be. And let's remember, tariffs are basically a tax. They're a tax on stuff that's coming in from another country, and that's going to have a bearing on what you're going to pay for things. So based on that, I mean, theoretically, that could lead to an increase in inflation as opposed to watching inflation decrease. You're going to find that the economies in whole globally are going to slow down, with the American economy being the largest one in the world. That's going to have an impact is how these things are going to go. And of course, that's going to affect what's going to go on with rates. Whether we're going to see rate movement in the U.S., whether we're not going to see rate movement in the U.S. There's a variety of different things going on. And again, a lot of this is based on how that tariff scenario is going to work itself out. But we're already seeing the economic impact globally going on, and especially we've seen it in this country as to some of the layoffs that may be happening. And that leads to a few other things that go on with the economy as well, both here and down south.
Yeah, it certainly does. In the last update in March, we did mention some signs that we were watching for economic stress. We looked at credit spreads, the financial stress index. Both of those have moved up, not to levels where there's alarm bells, but they're certainly higher than they were a month ago. So those are signs of a few cracks in the economy. And you hinted at this, Kevin, as well. The expectation, I think for many, was that this tariff stuff might mean a flight to quality, more people going to the U.S. because it's the biggest economy. So you would see their dollar strengthening and their rates going down. And in fact, you've seen the opposite.
Yeah, I mean, basically what we've got is that the U.S. dollar has been moving down, and you've seen bond yields going up. What you found is that other countries that thought the U.S. was a safe haven, that own U.S. treasuries, have been dumping them onto the system, not in a large portion, but it has had an effect. That's driving the bond yields up. Again, it's the same sort of thing you're finding in the U.S. You're finding U.S. hedge funds are getting this because they don't know what the tariff situation is going to look like. And as a result, that's been a huge cause for the U.S. dollar going down and bond yields going up. People are not buying as many U.S. dollars anymore. They're buying other foreign currencies. And this was definitely not what the U.S. saw happening based on the tariff scenario.
No, the expectation was the opposite, right? You'd see lower interest rates, a stronger dollar. And in fact, you've seen a weaker U.S. dollar, and you've had rates actually start to increase, bond yields in the U.S. For folks at home, The real question is the volatility for their portfolio, right? Markets have been very turbulent. Some people own stocks, so they feel that volatility. What does that mean? We mentioned in January, we thought it could be a turbulent year. We mentioned in March, this tariff situation is probably not a 1 or 2 week thing, probably a couple of months. And then likely in a longer term, we had a signal there that said maybe 9, 12 months out, could actually see some nice returns and positive numbers, but in the short term will likely be volatile. We still think that is the case. The last week and a half has been positive and a nice relief. I don't think it means we're out of the woods. We're probably going to have this tariff volatility for the near term.
Yeah, and again, the uncertainty created by the tariffs has created that. So as volatility gets higher, you find that people tend to move in and out of markets a little quicker, or they don't feel as secure as they did beforehand. That's something that you just sort of you work through in the near term. And as Clint mentioned, 9 to 12 months down the road, we feel that this is still going to be more of a positive scenario. At the end of the day, things will work their way out, but that volatility probably will continue over the short term, just because we've had these massive moves up and down, and it may not be over completely yet.
Exactly. And a common feeling, and we've talked to many clients, and I appreciate this sentiment, is when things happen, you want to take action. We got to do something.
Yes.
Markets are turbulent. We got to do something. Often that something usually means selling some of the investments or lowering the risk. And the concept is often we sell, and then when things settle out, we're going to get back in. We're just going to wait out the storm, and there's an immediate relief because you sell and then you feel real good, because the headlines are still scary and you're on the sidelines, but then getting back in gets very, very tricky. And that's what this slide is all about. It is from Ritholtz Wealth Management. It looks at the averages of all bear markets since 1957, so we have a lot of data there. And when the U.S. market goes down, you'll notice the S&P 500, the stock market, tends to bottom here, and then earnings per share doesn't bottom for about 9 months on average. So effectively what that's saying is that the stock market bottoms and starts rallying, and companies are still saying it's tough slugging. And then the companies finally turn around and say, you know what, things are getting better. We're making more money. Earnings per share is going up. But by then, the market's already been rallying for 9 months. So by the time the dust actually settles, well, it's probably too late for the market. You've already missed a big chunk of the rally. One more here on the same theme. The prior one was an average of every market since 1957, all the down markets since 57. This one looks specifically at 2020. To be clear, the drop in March of 2020 was a much greater magnitude than anything we've experienced so far, pretty much double what we've gone through. So 2020 was by far worse, but the speed would be similar to what we've seen now. So perhaps that's why it's a good comparison. But same idea. Earnings per share took 13 months to bottom, and the market bottomed very quickly. And then the GDP, if you look, all right, not just companies making money, but the overall economy, again, took a couple of months to bottom, and it was after the market already moved. So the market's forward-looking, investors trying to see what's around the corner. Market moves first, and then the economy and the earnings per share tend to follow afterwards. So the idea that eventually there's going to be a time where things settle and you can get back in, Kevin, the dust never really settles.
No, exactly. And as you just mentioned, I mean, economics 101, economists will tell you that the stock market is a leading indicator of how things are going, and it usually moves long before you find out the bottom ever comes to conclusion. I mean, this slide here in particular is giving us that sort of scenario. If you look in the background from Kramer, it's basically saying that the Dow's best week since 1938. And then, of course, if that's a great news indicator, well, what you're finding is that the opposite's happening on the bottom. More than 16 million Americans have lost jobs in 3 weeks. So as we're seeing, it is a leading indicator. The markets start to move long before you get that sort of finalization as to where the economy's bottoming. And again, that's what happens traditionally. You hear that bad news is coming. Everybody sells off in the market. Next thing you know is that it slowly leads to that. But by the time that's happening, people feel a little more secure. They're finding market bottoms. They're starting to buy back in. That sort of gives you that sort of the dust really never settles. The bad news is continuing to be sold, but all of a sudden the market's going up. It's sort of an inverse. It doesn't look like it should happen, but that's the way it happens. So if you're waiting on the sideline, you never really know when to get back in because you're not really sure, because the dust doesn't really settle. And that's sort of the area that we're at based on this slide alone.
Yeah, in this clip, I think it's a screenshot from Jim Cramer's show on CNBC from April of 2020, so pandemic era. And I got it from a blog, Wealth of Common Sense. They are talking about the screenshot. But it kind of comes to the idea of, all right, we're in this turbulence. If we're not just going to sell and try to jump back in, how do you endure these turbulent markets? No one likes the volatility, Kevin. It's never easy. So there is no simple method to endure it. It always feels a little uncomfortable, but there are a couple of good tips that can help.
Yeah, I mean, basically, you automate your good decisions ahead of time. Things that you plan. I mean, nobody ever plans for a market or a market downfall. But if you've done things ahead of time beforehand, which you've been taught with, then these are going to go on. So if you're dollar cost averaging by putting something in every month, continue that. Just because the market's down, it's just going to give you better prices to buy in at. Over the long term, that's going to work for you. And of course, the Becker Orr mantra has always been have a plan. If you have a plan, follow that plan. I know it feels uncomfortable at these times when markets are up and down and up and down. But if the plan has been set for 10, 15, 20 years, this next 6 months is probably going to be a very short time frame in that. So following the plan going forward is going to be the biggest factor. And of course, we've mentioned over and over again, make sure that you're having diversification in the portfolio. If risk was never a big thing to begin with, if you have a balanced portfolio of some format, you do have places that you can hold on to. There will be some fixed income. There may be some cash there, and that's going to utilize what you need if you're a retiree that has payments or anything along those lines, so that we're not touching the stock market. We can allow some of those things to play through, and that's how you start to endure some of the turbulent markets that we've been seeing.
Yeah, and I'll reiterate that point. I think it's very important. If folks are retired, often there's a fear that, well, markets are down and I got to take my monthly payment. Am I taking from the bottom? Am I selling stocks when they're down? And if you do have that diversification, you have some fixed income, maybe you have some stocks or bonds that are paying nice dividends and distributions. So you have an income stream, and then you have that cash buffer that we talked about, some money on the sidelines there intentionally as part of the plan. Well, you've got lots of ways you can generate those income payments without having to sell the stocks. That's what we do for clients. We encourage that. That's all part of the plan. But that's why that diversification is important. You're not forced to sell the stocks at the bottom. You can leave them alone. There's lots of other ways you can generate that income and use that buffer during the turbulent times. Switching more to the markets here, what else should people expect? What should I expect? We mentioned in the US, rates probably not going to move right away. We talked about how the bond yields actually went up. There's some signs inflation could be a little sticky there with these tariffs. If that's the case, the Federal Reserve, the central bank in the US, might not cut right away. They might delay that. I still think eventually they cut. As the economy weakens, they might be behind the 8 ball to do a couple of cuts, but it could be at a slower pace. Not the case in Canada. I think in Canada, we are going to see some of that monetary stimulus. You likely see the Bank of Canada continuing the interest rate cuts, so lower rates is very much a theme. And then I know we are in the mix of a Canadian election, and frankly, Kevin, whoever wins, you're probably going to see some fiscal stimulus.
Yeah, again, that's the biggest factor for this country is that I don't think it really matters who's going to get in. I mean, it's back and forth with the main parties to deal with that, but you probably will. I mean, similar to the scenario that you saw in 2020 when everything was going down, you had to lock things up. Well, the way that the governments around the world helped out everybody is they gave them some fiscal stimulus. Here's some money to make sure that you can survive until we get through this sort of scenario. I would expect the same thing from the Canadian government here going forward. You're going to have certain areas that are going to have possible job losses or are going to have a difficult time striving through the next little while. I would imagine the government's going to help those areas out to make sure that they continue going forward in the Canadian economy. And I don't think it matters who gets in. And as you've mentioned, declining interest rates in Canada, will it be straightforward? Well, you may get a pause one time, but then you get a decline after that. And again, the U.S. probably going to hold for a while. It's all going to depend on how these tariffs work out. But you're right, probably a decline later in the year as to what's going on. These are things we should expect. We can't guarantee they will expect, but it's basically that's the way we're looking at things.
Yeah, and of course, if you do have questions, you want to review your plan or go through the portfolio, we do a lot of that each and every day, and we'd be more than happy to do it with you as well. So please feel free to reach out and we can have that conversation. Take care.